Trading lessons from poker. Kenny Rogers once sang, "You've got to know when to hold them, know when to fold them, know when to walk away, know when to run." Is there anything we can learn from poker to help enhance our trading, or are the two mutually exclusive? There are indeed many similarities between poker and the stock market. For instance, just as no one can predict which cards will be dealt, not a single person can accurately and consistently predict the market. The best one could do with both poker and trading is to put the odds in their favor. Let's take a closer look at some poker concepts that apply just as well to trading. Know when to fold them. This is job number one for a trader. Just as it's best for a poker player to fold a weak starting hand, such as an offsuit 2-7, it is wise for a trader to cut a poor performing stock quickly. The key in both scenarios is to take a small loss quickly and to save your remaining capital for a higher odds play. While this is not exciting, it's what makes the most sense mathematically. When you buy a stock, you want to see it put you at a profit right away. If it starts to run against you, it could mean your timing was off, the market is weakening, or the stock just doesn't have any momentum behind it. Make a commitment to cut your losses quickly before they get out of hand. I usually cut my losses at around 5%, with some occasional losses getting up to the 8 to 10% range. Number 2, if a hand gets weaker, it's okay to fold. Let's say you and your 4 friends sit down to play some Texas Hold'em. Because there are 5 players, you have a 20% probability of winning a hand before any cards are dealt. As more cards come out of the deck, the probabilities are going to change. As an example, maybe you start with a jack of spades and an 8 of diamonds on a hand. You are feeling pretty good, so you decide to play it. As the 3 community cards are dealt, your odds change again. Now, if an ace of hearts, ace of spades, and a king of hearts is dealt, your odds would be lowered to just 5.8% chance of winning. This is because someone else may have an ace or a king and would be in a much better scenario to win. Since your odds have gotten so much worse, it would be wise to fold in the above instance. If you had just 1 king, you'd be at a better chance of winning, and if you had 2 aces, you'd have an extremely high probability of winning. Notice how your odds change as each new card is dealt. Whereas you started out with good odds, now your hand has gotten weaker and you were wise to fold. The same thing goes with trading. When you buy a stock, you must think in this exact same manner. Some people think a stock is a can't miss and they just decide that they're going to hold it no matter what. They say, this stock is phenomenal. The CEO is a genius. The technology is fantastic. I'm just going to hold this one forever. The market, however, often has different plans. Trading is just not a simple task of buying and blindly holding. If it were that simple, everyone would be rich. Just as in poker, your odds are going to change after you purchase a stock. If you buy a stock and it starts to go up, that's great. That's what we are looking for. But after you buy it, if it starts to falter and loses a key support area, such as the 50-day moving average, then it's best to close out your position before things get worse. In the end, it's all about probability. Just as a hand can turn weaker, a stock will have less probability of turning into a winner if it loses logical support levels. Keep watch of a stock after you own it. If it pulls back on light volume and finds support at key moving averages, you're in a good situation. If you start to see heavy selling and the loss of key support areas or even a key moving average, it's wise to fold. Sure, the stock may be turned, but the idea is not to be perfect. The idea is to put the odds in your favor. Risk a little to win a lot. This is another key similarity between poker and trading. Professional poker players will continually place small bets in order to see which cards are dealt. They will repeatedly fold and take small losses over and over again. Then, when they are dealt a favorable hand, they will play it so they can hopefully win the pot. This one large win is often enough to offset their many small losses. The same goes for trading. A trader can take many small losses over and over again and still come out ahead in the long run. For instance, if you lost $100 on 4 trades and then won $500 on your next trade, you would still be profitable. Just like a poker player, you can survive many losses as long as you keep those losses proportionally small when compared to your winners. Some hands or setups have better odds than others, so wait for the best hands. If you were to take a seat at a poker table, would you rather have a pair of twos or a pair of kings? Even an amateur would understand that the kings are the better play. Just as some hands have better odds than others, some stock setups are more likely to work than others. For instance, many new traders fall into the trap of looking for beaten down stocks that are near 52-week lows. This is a very dangerous strategy. Stocks that are selling off are usually doing so for a reason. Remember, the smartest minds are on Wall Street, and they are running institutional money. If a stock is being sold, you can bet there is a reason. Stocks that are dropping may be doing so because of poor future prospects, macroeconomic factors, or some unforeseen issue that is not yet fully understood by the majority of traders. But the reason doesn't really matter. The truth is, stocks tend to move in accordance with the line of least resistance, as Jesse Livermore used to say. Just like a rock rolling down a hill, a stock with poor action often goes lower. What the amateur views as a bargain, the professional realizes is usually down for a reason. Conversely, stocks near new highs are there for a reason as well. Stocks that are resisting bearish conditions are indicating a reluctance by their owners to sell. This sign of relative strength is usually a good clue that the stock has a promising future. In addition, stocks near new highs have less resistance and overhead supply. When a stock is in an uptrend and at a new high, everyone is happy, thus often leading to a steady uptrend. As the stock goes higher, more and more people notice and are looking to buy. However, a stock near new lows has massive amounts of overhead supply. Previous buyers look to sell on rallies in hopes of getting out at break even or at least with a limited loss. This leads the stock to facing firm resistance as it tries to move higher. Just as various poker hands have different odds, stock setups have different odds as well. Place the odds in your favor by sticking to stocks in strong uptrends and making a commitment to avoid stocks in strong downtrends. You can still lose with a great hand, so think about the long-term probabilities of your decisions. All poker players have been there before. You're dealt a pair of queens and things are looking good. The flop comes and the community sees a 10 of clubs, a 5 of diamonds, and an 8 of hearts. On the turn, an 8 of diamonds pops up. At this point, you are still feeling great, since you have a good chance of winning. But remember, it's just a chance. There are no guarantees since you really don't know yet what the other players are holding. The river is a 2 of clubs, and now you're still feeling really good. The other players reveal their cards. To your shock, one of the other players has an 8 of spades and an 8 of clubs. With 4 of a kind, he's the winner. Now, that's just the way the cookie crumbles sometimes. You can get a really great hand, and sometimes it's just not your day, and someone else has an amazing hand. But let me ask you this. The next time you are dealt 2 queens, would you fold? Would you let the one experience deter you from playing 2 queens forevermore? Would you claim that poker is rigged against you? Of course not. The same thing goes for trading. You can see a stock with great fundamentals and a great technical setup, and sometimes you can buy it and you will get stopped out. This is just part of trading. Don't get disheartened or give up. Don't change your strategy or claim the market is rigged. It's just one of those things. Remember, if you stick to cutting your losses and continue to buy fundamentally strong stocks emerging from constructive patterns, you may not win on every trade, but in the long run, you will come out ahead. Bet bigger when things are going well. In Texas Hold'em, rounds of betting take place before the flop and after each subsequent deal. Players can check, call, raise, or fold. Players can choose to raise if they want to increase their bet. The same money management concept applies to trading. If you're in a stock that you believe has the potential to be a big winner, you can add to your position as the stock increases in value. In addition, you can increase your portfolio exposure to the market as your equity curve starts to rise. The idea in both poker and trading is to have a big bet on in the high odds scenarios when you are likely to win, and to have a small bet on when you are likely to lose. If you lose all your chips, you can't bet. Legendary trader Larry Hite once remarked, "I have two basic rules about winning in trading as well as in life. Number one, if you don't bet, you can't win. Number two, if you lose all your chips, you can't bet." This pretty much sums up what traders and poker players need to do to survive. On the one hand, you have to be willing to bet. You have to be willing to place at least some of your money at risk. However, you can't lose everything or it's game over. The key is to find a balance. I like to make a rule to never risk more than 1% of my account on any given trade. This allows me to manage my risk so I know that I could survive a series of 3, 4, or even 5 consecutive losses in a row without getting myself into too much trouble. To download a free spreadsheet to help you calculate your risk on each trade, visit my website. Number 8, discipline is everything. Mike Tyson once said, "I don't care how good you are at anything. If you don't have discipline, you ain't nobody. You are nothing without discipline because you give up under the slightest struggle." Discipline is doing what you hate to do. Discipline is doing what you hate to do, but doing it like you love it. It can be difficult to cut losses. It can be difficult to tune out the noise of Wall Street. It can be difficult to sit and wait for a fat pitch. But guess what? This is what separates the successful from the unsuccessful. Just as the best boxers and athletes have the discipline to train while others sleep, the successful trader must have the discipline to follow their plan even when they don't want to. Poker players are known for their emotional control. They don't scream and shout and celebrate when they get a pair of aces, and they don't cry and sob when they don't like the cards that are dealt. To act in this manner would completely destroy their mystique at the table. My girlfriend's brother is an excellent poker player, and he has won thousands of dollars in tournaments at Vegas casinos. It's really no surprise to me that he is successful. You know why? He's got great control over his emotions. He doesn't let the fact that money's on the line cloud his judgment. He simply does what needs to be done as he is dealt each hand. Likewise, a trader must be able to control his emotions while he's in a trade. Never let your fear or greed cloud your judgment. If you're getting emotional with your trading, it's best to trade a drastically reduced position size. Moreover, the addition of meditation and yoga can do wonders for the psyche. I make it a practice to dedicate the first 15 minutes of every day to meditating, and it's one of my favorite parts of each and every day. Try it out and see what it does for your life. Know when to run. Just as Kenny Rogers warned, you have to know when to run. There are times when the best thing to do is get as far away as you can from the market. Now, I don't mean completely ignore the market, but I mean do not trade in the market. As Jesse Livermore put it, there's a time to go long, a time to go short, and a time to go fishing. There will be markets that are so choppy and volatile that it is best to run as far as you can from them and just simply wait until conditions improve. New traders often suffer from one of two flaws, either a total disregard for risk management or overtrading. Trying to trade through a whipsaw market or failing to respect risk can totally annihilate a trader's account. If you are having trouble with your trading, take a step back. It's perfectly okay to stop trading if the market is hostile or uncooperative. Remember, the market will always be there. Just make sure you are. Traders who feel the need to trade regardless of market conditions tear their accounts and psyches to pieces and are left with nothing when the new bull markets and strong uptrends arise. Don't let that be you. Know when to walk away, and most importantly, know when to run.